What's going on, everyone? Lolit here. $100 guaranteed per trade, no BS, but how? You can do it, anyone can do it. It's actually quite straightforward. And here today, I'm here to explain not just the spoken definition, but actually go through it step by step using Robinhood's app. What we're gonna go over today, specifically in the options realm, isn't actually as active as one may think in the capacity of a day trader, where you have your pre-market, your post-market, during the market naturally, etc. Where I love the strategy because it's somewhat passive in a way, and it can be totally passive depending on how you structure it. Which, to make it clear, this is also another way of passive income. Check out this video for the basic terminology of options if you're unfamiliar. And if you're familiar with the strategy and want to skip forward, do check out the timestamps and skip forward over this upcoming spoken definition and straight into the more hands-on part of how to actually execute upon this. The wheel strategy, what is it? You have two options. You have a call and you have a put. And in terms of the order of execution, how we do this strategy is first we sell a cash covered put and then we sell a covered call. And so the mechanics are you have a cash covered put, and whenever you're selling an option, selling a put or selling a call, you'll receive premium. And this is because we are intrinsically taking the risk. And so when you're selling a cash covered put, since you're agreeing to buy stock in the future at a certain price at a future date, and for example, that could be far higher than what that current market price could be in the future, since we're taking that risk with our collateral that's being put aside for the actual execution of the trade, we are getting some premium. And so someone that's buying the put contract, they're going to be giving that premium to someone, and it's someone who's selling that put contract, which in this case is us. For example, if you have a stock that's trading at $100 today, and let's say a week from now, you have a cash covered put for $80. Chances are, depending on the stock, it may or may not get all the way there, but it just depends on the stocks we're dealing with. But the point is, you'll receive some premium for that strike price. It may be a lot, it may be nothing, but depending how you structure it, you can definitely get a lot of premium up front. And again, it goes back to risk versus reward. For example, if it's not in the money, then basically you're never gonna get assigned these shares. And what that really means is when you sell a cash covered put, you're agreeing with someone, aka someone is kind of buying insurance. And just like insurance, by the time that policy is over or the contract expires, basically you've kept that premium from the person buying the put contract, but other than that, nothing happens, and you've basically gotten quote unquote free money, but naturally there was some risk. A covered call is being covered in your position. And what this means is you have 100 shares per contract, as each option contract deals with 100 shares. So these 100 shares are what you can write a call contract against. So whenever you sell this contract, you basically are receiving premium because you're agreeing to sell these shares at a certain price at a certain date. And so because you're agreeing to sell them at a certain price, for example, if you have a $100 stock that goes to 200, but you agreed to sell it at 125, you're definitely going to be capping those gains, because after 125, the stock could go to 200, 300, but you're not going to realize any of these gains. The point of this story is really to say that you still receive a premium though for the risk that's into that contract, that's baked into it. So with the wheel strategy, you're receiving a premium when you sell a put and also when you sell a call. And ideally, depending how you execute the strategy and structure it, you can actually let go of your shares at the money. So you're more playing the premium game, aka getting that income, or you can hold on to these shares if you're really bullish on certain types of shares. For example, the FANG stocks, Facebook, Amazon, Apple, Netflix, Google, etc., and Microsoft included. But the point is, you may not want to be assigned depending on how you're trying to invest, and that's a personal decision. But definitely from an income perspective, this strategy is quite straightforward, and let's get into the actual details. So here on the screen, we got Palantir Technologies, ticker symbol PLTR. So what you do is you press trade, and trade options, if you haven't activated it, you'll have to request access through the app or through your brokerage. And so you press trade options, and let's just say November 27th. And so this is a week from today, from the time of this recording. And so 1890 is where the share price actually is. And so 1890, 1891, it's going to change naturally. And so what we're saying is if we see the put contracts, at the top it says selling a put. And so the price for buying a put and selling a put, it's going to be the same because someone's willing to pay X amount of money and we're receiving that same amount of money. So buying and selling, the price should be the same, particular to that option of a call versus a put. So 63 cents for $18 put. So what is it saying? What it's saying is 63 cents a share is what someone is willing to pay in premium for you to buy Palantir at $18 even on November 27th if it were to land in the money or that option is exercised. And so someone is willing to pay 68 cents per share, which in an option contract has 100 shares, you would receive $68 total. And so for the sake of this video, to receive $100 per trade for sure guaranteed using the strategy, of course, we could say that you can get at least 50 on the selling put side, and then when you sell a call, 50. But let's say, when do we get more than 100 in total premium? And that'd be next week, December 4th. So if we press $18 put, naturally you have a bid and ask, so 115 to 125 range, where it says 120. So for example, if you press one contract, your minimum credit that you would get if it assumes the limit price of 120 is you're going to get $120 straight in cash, straight to you. And you can look at it at a few ways, but we'll go over the debrief at the end. This is more of the hands-on part. So $120, if you review it, the thing is not enough collateral, which is essentially saying that I don't have the $1,800, which would be the total purchase price, $18 a share times 100 shares in a contract, in my Robinhood at this time for Robinhood to take it as collateral. And so it can happen, you can submit a deposit, but in this case, I'll press cancel. But ideally, you would submit your deposit or have the money there for it to be as collateral, and then you would actually have that money locked up, and then you would get that credit immediately, instantaneously, when that option is sold to the person buying it on the other side. Now let's flip the script and assume that you already have these shares at $18 because of your put contracts, and so now let's look at the covered call angle. So you press trade options, and let's say that our expiry is that same December 4th. Let's just say today you already have these shares. And over here, you have a $19 call, and we know our average price was 18 bucks a share. So right here, even if you sell it at $19 call, what you're getting in premium, the bid and the ask, it's $1.65, between $1.65 and $1.75, aka $170 total if you take the mid price. And so one contract, it looks like this. And this is agreeing to sell your shares at 19. Now, this is basically it. You basically got premium when you sold a put, you got premium when you're selling a call like this, and so you're extracting actual real cash from the positions you already have. And this is literally, you can do it for every single trade, just depending how you structure it. And so with that, I want to go to another example, and instead of taking a more IPO and growth stock and a stock that's actually increased heavily of recent, we're going to look at Coca-Cola. I picked Coca-Cola because it's more of the blue chip, and also it pays a dividend. And so it's interesting to see kind of a stock that doesn't move as much. What does that look like in terms of these premiums that you can collect? And with Palantir, we were talking about more that $1,800, $1,900, $2,000 range in general for the total purchase price. But with Coca-Cola, with it being 53 bucks a share, we would be talking about $5,300 in collateral, just a heads up there. We press trade options. Let's go to December 4th, and we're going to be selling a put. So if we're agreeing to buy 53 bucks a share for Coca-Cola, if we agree to pay this price for Coca-Cola shares, there's someone on the other side who's willing to pay between $1.02 and $1.07, aka it's above $100 right here in premium as well. So that's pretty cool. Now I'm going to fast forward because we went over more of the nitty gritty in the Palantir example. So now this is selling puts, and on the other end, let's say you had the shares already, let's say you want to sell a call, and let's say your average price is still that $53, you could sell it literally at, look at this, $43.50, and you can have a premium of 47 cents. So what I'm trying to say here is, in terms of the $100 example we were talking about, you have kind of this triple income strategy play with the wheel strategy. So you have 53.5 from 53, you would already get 50 cents locked in profit if your shares were to be sold at that price. So that's 50 cents a share. And so with the premium being 47 cents, but the bid and the ask being between 42 and 52, you could put a limit price for 50 cents even. And the reason for this is more for the example of this video, where you're getting 50 cents in profit when you sell these shares that you got at 53, you're selling them at 53.5, so 50 bucks profit on the actual selling of the shares. But in premium up front, you can actually ask for $50 even, and seeing just how the bid and the ask is, it may take just a few seconds extra for it to actually execute, but at the same time, you can always, go through different times and make sure you get the price that you want to get that type of premium that you want. And it's all in the end, risk versus reward. Debriefing and talking about some of the pros and the cons of this strategy. So I'll talk about selling puts first. Selling puts, the advantage is when you do collect a premium, you're basically also decreasing the average cost in which you get those shares. With selling puts, you get premium, and premium really is decreasing your average cost. For example, if we take Coca-Cola's $53 put example, basically you have $5,300 that is put aside in terms of collateral for it to be taken whenever and if that contract is exercised upon. And so with $5,300 put aside, we're receiving $100, for example, and that's upfront. So that $100 is what we get immediately in terms of a minimum credit or net credit. And in terms of what's going out, when the actual sale is executed, it's $5,300. But net, that's $5,300 minus 100. So we're really spending only $5,200, aka $52 a share. Even though the contract was for $53, it's because we got that much premium. It's pretty much a huge advantage in this situation. A disadvantage of selling puts is naturally, so let's say we agree at $53 a share for Coca-Cola, but now let's say Coca-Cola goes to 40 bucks for whatever reason, the Rona, etc. So basically, you're willing to spend 53 a share, but if the market price is 40, then you're stuck there sitting on a huge position in relative to the average cost of what it could be if you were to execute at market. You wanted the premium, and that's great, and you got it. It's guaranteed money upfront for sure, 100% every single time. But with that, it's just important to note the risk versus the reward. Coming to covered calls, you have the position, so you covered, you actually own the shares, and you can see any appreciation of the shares, because when you're selling a put, it's just cash that's aside, but you don't see any dividends, any potential gains on the stock, because innately you don't own the stock at that time. But with a covered call, your actual principal position, the base position, the shares themselves, they can appreciate, and you can have appreciation in the background. But where the advantage comes is that in this case, if you want to see that appreciation, you don't want your strike price to be in the money, because what happens is if it's in the money at expiration, chances are it could be called away from you. And so because you agreed at a certain price to give away your shares, you won't see any profit after that angle. So the advantage is, again, you get that premium. But the disadvantage is with capped gains, you're agreeing that after a certain point, you won't see any appreciation, but you definitely got that premium just like when you were selling puts. And so the difference really is that with selling puts, your maximum loss is basically if the stock price goes to zero, you agreed to spend X amount. So that difference is what your actual potential loss region is. But on the other end with covered calls, basically you've already capped your gains. So if you buy a stock at, for example, that 53 and you sell it at 53.5 and Coca-Cola goes to 60 to 100, just an example, you won't see any other appreciation above the fact, but you definitely are going to get that premium as well as any other appreciation between your average cost and then your strike contract price. We usually end with a beatbox outro, so thank you so much for coming to the end. Like, share, subscribe, you know how it is, and drop any questions down below. Happy to answer them. So with that, see you soon.